Hello and welcome back, options traders. And I guess everybody has heard the news by now about negative oil prices. So on April 20th of 2020, we saw the May futures contract drop to negative $38. So how is that possible and what does it really mean? So just in case you didn't see the headlines, these are some that we've been seeing here recently. First time in history this has ever happened. So what's going on here? How can we end up with negative prices? Well, first of all, let's take a look at a little graph of how things normally work. And what we're looking at here is just a list of futures prices. So these are dollars. So as the price of a futures contract is higher, it sits up towards the top of the graph. And when it's lower, it sits down here. So here's zero. Now in the markets, you can either take a long or a short position. So everything to the right of zero here are the long contracts. This would be like +1, 2, 3, 4, and so on out here. And to the left of zero, -1, -2, -3, and so on. We get shorter and shorter. But then we have what's called an expected spot price. So this is more of a hypothetical. You can't go and look up what the expected spot price is. But you could think of it as if you were to go and interview all of the players, all of the hedgers and the speculators and the end users. What do you think the futures price is going to be, let's say in 30 days or in 60 days? And we took some kind of an average. So it's a thought, it's an idea, and it's called the expected future spot price. In the commodities market, the spot price is the price where you can buy it right now on the spot. So that's the current, or what's called the cash market. So what we're saying here is, where does everybody think that future cash market's going to be? Well, now we got to look at the different players. On one hand, we have producers. So these are going to be the actual people digging it up out of the ground. This would be like OPEC and Exxon and people like that. And so what it's showing is that they are usually on the short side. They're long spot oil. So to hedge that potential risk there of falling prices, they would like to sell contracts against it and lock in their prices. So notice that if the futures price of a contract is close to zero, yeah, they're not real interested in selling contracts. Who would be? Who wants to lock in a low price? But on the other hand, if the futures price is rising way up here, now they get really motivated to sell to lock in those higher prices. So that's why this line slopes out this way to the left. In the other corner, we have speculators. Now speculators are typically going to be long because they are on the opposite side. That's really what the producers are paying them for, is to take the other side of the market. So how are they paying them? Well, notice that speculators will take the long side only if the futures price is below where everybody thinks it's going to be. So if everybody thinks it's going to be $10 in a month and it's trading for 9 or 8 or 7 way down in here, speculators become more and more motivated to buy. Right? If you can buy it for 5 and sell it for 10, you'd be super motivated to do it, as opposed to if it was trading for 9 and everybody thought it was going to be 10. So the lower the futures price, in other words, the bigger the discrepancy, the more that speculators are willing to take the long contracts. And that's why this line slopes out this way. However, if price gets above where everybody thinks it's going to be, speculators actually turn negative. They don't want to buy, they'd like to also sell. The final point to note is that if the futures price is right about where everybody thinks it is, speculators have no incentive to buy. They're going to sit right here at zero. Why? Why would you buy a contract for, let's say, $10 if you thought it was going to be worth $10 at the time you were going to sell it? That's taking risk for no compensation. So speculators are going to say, I just have no interest. So the speculators get pulled into the market only if the futures prices are above where everybody thinks or below where everybody thinks. So let's say that this chart represents the oil markets. Based on what I've drawn here, where would the price be? Well, the price is going to have to settle somewhere in here. Why is that? Well, take a look. If you look at this distance here and this distance here, that's about equal. So let's say that these are, let's call that segment A and this is B. The length of A right here is equal to B. That's the only point on the graph where that's true. And this has to be true because in the futures market, for every short contract, there must be a long. You can't just have net long or net short. They've got to be equal. So notice that the way I've drawn this, that the futures price is going to be below where everybody thinks it's going to be. So this is very common in the oil markets. It's actually what's called a normal backwardated market. I know it's a horrible word, but that's all it means, is that people are expecting this futures price to climb over time, and therefore it gives the speculators some kind of an incentive to take the other side. And that little discount here is, you can think of it as a insurance premium that the producers are paying to entice the speculators. So that's why a lot of times it will settle below where everybody thinks it's going to actually be. Now normally this cycle just continues. Producers pump it out of the ground, certain amount, they deliver it to speculators, but they will also deliver it to what we might call the end users. So I'm just going to put like Delta as an example to remind you of what we're talking about. So Delta is not really speculating in the oil market, but they are trying to take delivery of it. They want to be long oil in the future. So they would typically be long. So this cycle just continues. But here's where things start to get interesting. When we got to the delivery, to the expiration date of this delivery month right here, that everybody was long. Producers aren't pumping oil out of the ground. They don't have a storage problem. They've got the best storage in the world. They just leave it in the ground. But that's not true for the end users or the speculators. So what happens now is that Delta normally says we have X amount of gas that we need or oil, and we're going to use it in our production, our day-to-day use, and then we're going to replenish it. Well, they're not in need of it anymore, and they don't have storage facilities. So what's happening is that it's just a battle between the longs. You've got end users who are long on this side of the graph, and you've got speculators. The producers are basically out of it. So what's happening now is that in order for people like Delta, let's say, or your local gas stations or whoever are end users of oil, they have no place to store it. So they have to entice a speculator to take it off their hands, or potentially another end user. Maybe there is another end user who does have storage facilities, but they're saying, you know what, we're getting pretty much tapped out here. We really don't want it either. But if you're going to pay us $30 a barrel, we'll take it. So the main reason that they're going into negative prices is that it's these end users who are just trying to dump off their anticipated supplies that they don't have room for. So they're just trying to pay a credit to get somebody else to hold it. Now what's going to happen in the future is that this will eventually iron itself out. The producers will start changing the production to meet the demand, and you won't have this problem. It was really just because of such a sudden change and plummeting of the demand. And so for the first time in history, we've seen negative oil prices. So again, that doesn't mean that in the near future you're going to drive to your local gas station and they're going to pay you to fill up your car. This is really just a battle between the speculators and the end users who all happen to end up on the long side of the contract at expiration. So hopefully that adds a little bit of sensible insight into what otherwise seem like nonsensible markets. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.